can you elaborate on the market sentiment? Of course I can. The market sentiment tool is a tool that Ernie developed based on 13 broad-based indicators that are usually pre-predictors, in a sense, of market movement, looking at things such as the put-call volume ratio across the entire market. Using SPX, he's found is a better gauge, more reliable gauge than NDX or, say, the Russell 2000. But the number of days up for SPX, the gap over or under the 20-day moving average, the percentage of total stocks above their 20-day moving average, stocks hitting their new 52-week high or 52-week low, the volatility index, the VIX, TRIN, the RSI of SPX, gaps over the 20-day, 100-day, SMA 100, number of days, and the percentage of stocks of the SMA 100, and MACD as well. Now, Ernie went through about maybe 75 to 60 different criteria, broad market criteria, and he analyzed the fences. What do I mean by that? So when I click view overall sentiment, we see where we've gone into these different realms here, where we start to get many more bullish indicators than bearish. And when we hit a range where we've got more bullish indicators than neutral, usually, that's when you start to see those bullish buys or the strong bullish buys. And what I mean by the fences, let's take a look at put-call volume ratio. Each time you click on the individual details, you see a histogram for this particular filter, the put-call volume ratio across the market. And what I mean by fences is that very infrequently does the put-call volume ratio go above 1.2 and stay there. Very infrequently does the put-call volume ratio drop below, say, 0.5 or 0.6 and stay there on a consistent basis. It typically rebounds from where those values are, which means the volume ratio has to shift, which means you're usually seeing the market pattern shift as well. So here we are currently at a put-call volume ratio of 1.19, almost 20% more puts than calls on the market. Now, there could be a few days more of increased put-call volume ratio, but eventually it doesn't stay there long. It has a tendency to revert back, where more calls are starting to be bought than puts. The ratio goes back to a level of 1, back to maybe a level of 0.9, back to a level of 0.8. And for that to happen, that means more calls are being bought than puts, typically means the market is back moving up in price. So this has now entered its bullish fence. It's in the bullish range. Other ones we see in the bullish range, of course, are percentage of stocks over the SMA 20. Only 11% of optionable stocks, indexes, and ETFs are above their 20-day moving average. Someone had asked me earlier today, why am I not seeing many results in the default bull put credit or what was the other one he was looking at? I can't remember. It was weekly covered calls. And it's because we're looking for positions as a default screen, a default filter, they're trading above their 20-day moving average. 11%. That's the percentage of stocks currently over their 20-day moving average. That's why you're seeing less results maybe in the naked puts, weekly naked put default screen, weekly covered call default screen, bull put credit spreads. Because in addition to having to meet that one stock filter, it has to match the other criteria as well for return, probability, range out of the money, positive earnings per share growth, positive MACD as well. Not a lot there right now. But as you can see, as we talked about before, very infrequently does this stay below 10. It has a tendency to push back historically and move back up over time. And very infrequently does it go above 75 and stay there. Usually it has a tendency to snap back, which means the market's pulling back in those positions. And you can take a look at this in addition to the histograms. You can take a look at the distribution over time versus SPX. So as you see as a trend here, we got almost up to 80, 90. Oh, this is back in 2013, of course, I think. Oh, no, this was recently. I'm sorry. Looking at that wrong. This is 2005, February 5th of 2023. SPX was up near 4150, and we were hanging around at 80% of stocks above their 20-day moving average. And they fell to the norms, came back up, didn't last too long. News came out now, and we're back down here. But you can see this historically. I can look at all. I know that's a lot to look at, but you can kind of see here how it follows the trend that when we have these higher levels, it tends to drop. And when we get to the drop, it tends to push up. So you can take a look at that on the various ones, different histograms and the different distribution against SPX. Number of stocks hitting the new 52-week high, minus 8.6%. Okay, so new stocks hitting their 52-week high and low. We're seeing a dearth of those. The trend, of course, bullish. VIX is almost bullish. A number of days over the SMA 20. We've been down so much, of course, so we're 15 days below the SMA 20, it looks like, for SPX. And again, you can see it might drop down to 20, but very infrequently over time does it stay below that 20 range. It snaps back up, and obviously for that to snap back up, what has to happen? SPX, SPY has to move back up. That's why you're seeing the bullish buy indicator right now, because what did we say? 7 bullish indicators have been triggered. There's no bearish indicators right now, even though the market's falling. And we've got 6 neutral with 2 or 3 primed to move into that bullish fence area as well.